The government is extending you an offer right now. Direct up to $32,500 into a traditional 401k this year if you are over 50. If you fall between ages 60 and 63, that ceiling rises to $35,750. The financial media labels these catch-up contributions. Human resources departments frame them as an opportunity to compensate for time lost. The logic appears bulletproof. You have more capacity to contribute now, so contribute more now. Straightforward enough. Except the very same tax code that allows you to load up the account also compels you to drain it on a government-dictated timetable at ordinary income rates through a three-way collision with Social Security and Medicare that can push your actual marginal tax rate past 40%. And the more aggressively you fill the account, the harder that collision hits. The people who executed the advice flawlessly are frequently the ones who pay the steepest price for it. This is not an edge case. This is the default outcome for disciplined savers who never modeled what the money actually looks like on its way out. So here's what I want to cover today. There are 4 distinct mechanisms embedded in the standard retirement system that all work against a large pre-tax 401k balance after age 50. They are not random, they are structural. They interact with one another, they amplify one another, and they were not engineered with each other in mind. Which is precisely why no one ever assembles the complete picture. I am going to assemble it. I am going to show you the numbers, and at the end, I will give you 3 specific actions. Not general guidance, but moves calibrated precisely to this problem. Think of your traditional 401k as a pressure cooker. Every year you contribute, particularly after 50 when the IRS permits you to pour in additional dollars, you are adding heat and pressure to a sealed container. Yes, the contents inside grow faster than they would in an open pan. Tax-deferred compounding is real. The math behind it is not fabricated. I am not here to tell you the account has no value. But here is the detail that never gets mentioned in any benefits enrollment session. At age 73, federal law compels you to open the lid. Not when you choose to, not in a year when markets are favorable, when the government instructs you to. Whatever comes out is taxed as ordinary income at whatever marginal rate applies to your complete financial picture. Not the rate you estimated at 38 during open enrollment. And the larger the cooker, the larger the explosion when it opens. The more you packed into it between 50 and 65, the more pressure you created. And that explosion has a name. It has 3 names, and they all detonate simultaneously. I will return to this image repeatedly. Each time I introduce a new mechanism, ask yourself honestly, are we building wealth here, or are we building pressure? In a few minutes, I will show you how a single dollar of required minimum distribution income at age 73 can actually cost you more than $1 in total combined taxes. But first, let me explain why the retirement calculator you are using, or that your financial advisor relies on, is almost certainly producing a wrong number. Not because the math is flawed, but because it is solving the wrong problem entirely. Most people model retirement tax efficiency this way. I contribute to a pre-tax account at my current marginal rate, say 22%. When I retire, my income will be lower, placing me in the 12% bracket. I defer the 22% tax today and pay 12% later. That is a 10-point spread captured in compound returns across 25 years. It is a clean narrative. The problem is that it treats retirement income as though it exists in complete isolation. It does not. Let me introduce someone to make this concrete. His name is Robert. He is 68 years old. He worked for 31 years, maximized his 401k for most of that career, and leaned heavily into catch-up contributions after turning 50. He retired at 66 with approximately $900,000 sitting in a traditional pre-tax 401k. Social Security brings in roughly $28,000 per year based on his earnings history. His mortgage is paid off. His children are financially independent. His monthly expenses are reasonable. He has modeled this situation carefully. By every conventional measurement, he is fine. By his own calculation, he sits comfortably inside the 12% federal bracket. Robert is not in the 12% bracket. At 73, the IRS instructs Robert to begin taking required minimum distributions. Required minimum distributions are the minimum amounts that United States tax law requires individuals to withdraw annually from traditional individual retirement accounts and employer-sponsored retirement plans, and to pay income tax on those withdrawals. The purpose behind RMD rules is to prevent people from accumulating retirement accounts indefinitely, deferring taxation permanently, and passing those funds along as inheritance without the government ever collecting its share. The government has no interest in helping you build a multi-generational financial dynasty. It wants its tax revenue, and it wants it delivered on its own schedule. With a $900,000 balance, Robert's first required minimum distribution at 73 is approximately $34,000, calculated using IRS life expectancy tables. That $34,000 surfaces as ordinary income. It lands on his tax return exactly as a paycheck would. Add that to his $28,000 in Social Security, with the IRS formula also counting half of his Social Security itself as provisional income. And Robert's modified adjusted gross income crosses the threshold where up to 85% of his Social Security benefits become taxable. Not a partial amount. 85%. Social Security benefits may be entirely tax-free, partially taxed, or up to 85% taxable depending on a recipient's other income. The IRS applies a formula built around provisional income that counts not only wages or pension payments, but also retirement account withdrawals, interest income, and even half of Social Security itself. This means a seemingly modest IRA withdrawal or a required minimum distribution can trigger a domino effect, abruptly pulling a larger portion of Social Security into taxable income. So Robert's $34,000 distribution does not merely get taxed at his marginal rate. It simultaneously activates a mechanism that pulls $23,800 of his Social Security, 85% of $28,000, into taxable income, which then faces taxation again at his marginal rate. In certain situations, every additional dollar withdrawn from a traditional retirement account can cause up to 85 cents of Social Security benefits to become taxable as well. For many middle-income households, this tax torpedo causes their effective marginal rate across a wide income band to reach 150 or even 185% of their stated tax bracket. Many middle-income retirees can face a federal marginal tax rate of 40.7% on their own. Robert believed he was in the 12% bracket. He is functioning at something closer to 24 to 28% effective on each marginal distribution dollar once the torpedo effect is factored in. That is approximately the same rate he was paying when he originally made those contributions decades earlier. The arbitrage he spent 30 years carefully constructing evaporated. And it evaporated precisely because he saved so effectively. You believe the problem is that you haven't saved enough. The actual problem for many people who recognize themselves in Robert's situation is that concentrating everything into a single pre-tax bucket creates a tax concentration risk that remains invisible until your early 70s. When your income is theoretically fixed, your flexibility is at its lowest, and you are legally required to take withdrawals regardless of what markets are doing. By the way, if you find this content valuable, please subscribe. Otherwise, the algorithm may stop placing these videos in front of you altogether. Stay with me because this next part reshapes the picture further. And unlike the RMD torpedo, which does not activate until 73, this mechanism is being calculated right now based on decisions you are making this year. The second mechanism is called IRMAA, the Income-Related Monthly Adjustment Amount. It is the system through which Medicare charges higher earners more for the exact same coverage. And higher earner, in this context, begins at $106,000 of modified adjusted gross income for a single filer in 2026. For 2026, Medicare beneficiaries who earn above that threshold and who are enrolled in Medicare Part B and / or Part D pay IRMAA, a surcharge added on top of the standard Part B and Part D premiums. The standard Part B premium in 2026 is $185.00 per person per month. That is what your neighbor pays. With IRMAA, your total can climb to as high as $628.90 per month, more than 3 times the base rate. The 2026 IRMAA brackets impose Medicare surcharges of $1,148 to $6,708 per person. When modified adjusted gross income exceeds applicable thresholds for a single filer. For a married couple where both spouses are enrolled in Medicare and both land in the highest bracket, IRMAA can add more than $10,000 per year in additional premiums for the exact same insurance coverage. Here is the structural detail that connects this directly to your 401k balance. Most people do not discover they owe IRMAA until a notice arrives in the mail based on income from 2 years prior. Because IRMAA uses a 2-year look-back period, income decisions made today directly determine your Medicare premiums 2 years down the road. So the income generated by a 401k distribution this year, whether voluntary, forced by RMD, or triggered by a Roth conversion, determines your Medicare premium in 2028. You will not know the exact figure until the letter appears. You cannot appeal it retroactively. It is already locked in, and the precision of the penalty is striking. The boundary between each IRMAA bracket can produce a sudden surge in monthly premium costs. If your income crosses into the next bracket by a single dollar, your annual Medicare premiums can jump by more than $1,000. One additional dollar of income producing $1,000 in additional premiums. That is not a gradual sliding scale. That is a cliff. And your 401k distributions are the single most likely force to send you over it. The people who understand IRMAA are spending the years between 63 and 72 managing their annual income with surgical precision, staying below bracket thresholds, carefully choreographing Roth conversions. The optimal approach often involves front-loading Roth conversions in the years from 63 to 64, staying just below the IRMAA Tier 1 threshold, then scaling back conversion activity once Medicare begins to manage the ongoing surcharge exposure. The people who do not understand IRMAA are simply staring at their Medicare bill every month convinced there has been a billing error. There has been no error. They filled the pressure cooker too aggressively. Here's the part nobody ever draws on a whiteboard. The Tax Torpedo and IRMAA are separate mechanisms, but they operate on nearly identical inputs. Both are triggered by your modified adjusted gross income. Both are amplified by traditional 401k distributions. Both strike simultaneously after age 73 when RMDs begin. And because the 2-year IRMAA look-back means your 73-year-old self is paying for your 71-year-old income, the year your first voluntary pre-RMD withdrawals likely began. You actually have roughly a 24-month warning window that most people never take advantage of because no one ever told them it existed. Now, let me walk you through the third trap. This is the one that personally shifted my thinking from maximizing everything in pre-tax accounts to treating account location as deliberately as account size. Before you turn 50, portfolio volatility across a long enough timeline is essentially a secondary concern. When the market fell roughly 46% peak to trough during a 2008, and you were 35 and still contributing steadily, that crash was functionally a discount. You acquired more shares at reduced prices. Your existing balance had 20-plus years to recover fully. The sequence in which returns arrived did not matter much because you were putting money in, not taking money out. After 50, that arithmetic flips entirely. The risk is greatest in the 5 years preceding retirement and the first 10 years following it. A window sometimes called the retirement red zone. During this period, your portfolio balance sits at or near its peak, and any losses have the maximum possible time to compound against you. Sequence of returns risk centers on the timing of market declines and how losses arriving early in retirement can permanently reshape your entire income trajectory. You can earn the same annualized return as another retiree and still arrive at dramatically different results, simply because your difficult years appeared at the wrong point in the timeline. Here is the illustration that makes this genuinely tangible. Picture 2 retirees, each beginning with $1 million. Both average 5% annually across 20 years. Both withdraw $50,000 per year. The only variable is when the losses occur. Same average return, but a $665,000 difference in the ending balance. And the portfolio hit by the bad sequence was in serious trouble by year 5. $665,000 gone. Not because either retiree made a mistake, not because their average return differed, simply because the bad years arrived first for one of them. Research by Wadevau estimates that approximately 77% of a portfolio's final retirement outcome can be explained by the returns experienced in just the first 10 years. 77% of everything determined in the opening decade. You have been focused on 30-year averages. The system actually cares about what happens the moment you transition from being a contributor to being a withdrawer. Here is the connection that almost no one states explicitly. The larger your pre-tax 401k balance at retirement, the more dollars sit maximally exposed to sequence of returns risk. And unlike a taxable brokerage account, you cannot execute tax loss harvesting inside a 401k. You cannot strategically choose to liquidate during a down year to generate a capital loss deduction. The pre-tax account is sealed. It is the pressure cooker again. And when the market is down 20% and you still need income to cover your expenses, you are forced to sell at the worst possible moment, with zero tax strategy tools available, at ordinary income rates. Meanwhile, the investor who divided their savings between a Roth account and a taxable brokerage possesses something you do not: optionality. In a poor market year, the Roth investor draws income from the Roth. No taxable income generated. No Social Security torpedo triggered. No IRMAA impact. No ordinary income recognized at the moment of maximum portfolio vulnerability. They allow the pre-tax account to sit compressed and wounded, giving it room to recover. They liquidate nothing at a loss. They maintain control over their own financial narrative. They built a kitchen with multiple functional burners. You built one enormous sealed pressure cooker. Let me walk you through a scenario a financial planner documented publicly. The name has been changed, and call him Dale. Dale was 52, a mid-level manager at a manufacturing company, earning approximately $140,000 annually. A careful and consistent saver, he had maximized his traditional 401k every year since his mid-30s. By 52, he had accumulated roughly $480,000 in the pre-tax account. Not a single dollar in Roth. Almost nothing in a taxable brokerage account. His entire retirement savings infrastructure consisted of one very large, very sealed container. Every source he had ever trusted told him the same thing throughout his career. Maximize the pre-tax account first, always. At 54, his company was acquired. He was let go during the post-merger integration process. This is not an unusual outcome. Research from the Urban Institute found that more than half of all workers aged 50 and above lost long-held jobs because they were laid off or otherwise forced out involuntarily. That same research suggests many older workers encounter severe and unexpected financial setbacks during the precise period when saving and planning for retirement is most critical. Separately, approximately 5 years separates what Americans plan and what actually happens. Non-retirees target age 66 while most actually exit the workforce at 61. Dale secured a contract role at roughly 60% of his former salary. He continued contributing modestly. By 60, his 401k had grown to approximately $740,000. It looked like a success story from the outside. What Dale had never modeled was this. At 73, his projected RMD on that account, assuming continued compounding, would push him into the second IRMAA Medicare surcharge bracket virtually every year of retirement. That surcharge applied across a 20-year retirement accumulates somewhere between $50,000 and $90,000 in premiums paid above the standard rate. For the exact same coverage, seeing the exact same physicians, his neighbor, same age, same income history, but employing a split account strategy pays the base rate throughout. Dale's perfectly executed single bucket strategy cost him the equivalent of a perpetual car payment for the remainder of his life, with zero additional goods or services received in return. The penalty for discipline. The 401k, for context, was created through a provision of the Revenue Act of 1978. The original intent was to allow executives to defer bonuses and profit-sharing payments. It was not purpose-built from the ground up as the primary retirement vehicle for 160 million American workers. IRMAA surcharges were added in 2003. Required minimum distribution rules have been adjusted through the Tax Cuts and Jobs Act and Secure 2.0 over the past decade. These systems did not develop together. They grew up in separate legislative sessions, passed by different Congresses, and modified at different moments in time. They interact the way software patches interact with legacy code. Technically compatible, practically destructive for anyone who falls through the gaps between updates. Now, you might be thinking, fine, so I shouldn't maximize the traditional 401k after 50. But what about fees? Isn't the tax deduction still worth capturing? Let me address that directly because there is a fourth mechanism here that amplifies everything else. If you have $100,000 in your 401k and fees run 0.5%, your account balance will grow to $227,000 at retirement. If fees are 1.5%, that same account grows to only $163,000. A 1 percentage point difference in fees reduces your retirement balance by 28%. 28% from a single percentage point, not lost in a crash, not lost in a difficult year, but extracted slowly and silently in every single year your money remains in the account. The industry average has improved from where it once was. Average equity mutual fund expense ratios incurred by 401k plan participants have declined 66%. A 50 basis point drop from 0.76% in 2000 to 0.26% in 2024. That represents a genuine advancement. The fee compression era has benefited savers in large plans considerably, but plan size matters enormously. The average investment expense for 401k plans with 25 participants and $250,000 in total assets is 1.37% of assets. A $5 million plan carries average total costs of 1.08%, including advisor compensation. If you work at a mid-sized company, not a Fortune 500, not a tiny startup, you are almost certainly paying somewhere between 0.7 and 1.2% in total fees. That figure is meaningfully higher than the headline numbers the industry typically publishes. A 1% fee on a $200,000 401k held for 30 years at 7% gross return costs you roughly $170,000 in forfeited compounding. That is not a rounding error. That is a year or more of retirement income quietly extracted by a system you did not design, cannot exit, and likely cannot fully see on your statement. Because plan administrators do not send annual bills. They do not itemize fees on statements. Fees are reflected through the plan's reduced net returns, and most participants never notice. Now stack all four mechanisms together. The tax torpedo on Social Security creates an effective marginal rate of 40% or more on RMD income. IRMAA creates a Medicare premium cliff that can cost $10,000 or more per year for a married couple. Sequence of returns risk is maximized precisely when your balance is largest and your flexibility is most limited. And fees silently erode your balance by 28% over 30 years across a single percentage point differential. Each of these four mechanisms is proportional to the size of your pre-tax balance. Every additional dollar you direct into the traditional 401k beyond the employer match makes all four of these problems worse simultaneously. Here is the part that sounds nearly heretical after 30 years of consistent financial industry messaging. For many people over 50 who already hold substantial pre-tax balances, the marginal dollar beyond the employer match does not belong in the traditional 401k. It belongs in a Roth account, a taxable brokerage account, or some thoughtful combination of both. Depending on your current income, your projected retirement income, and your IRMAA trajectory,